Ladies and gentlemen, it is happening. We just witnessed the biggest banking failure since 2008. And even me, I've been warning about this. I've been telling you these things are going to be coming, but I didn't know it would be coming so soon. Time to prepare is over. We're in the middle of this crisis right now. And if you haven't already, you may have only days left to get your money out of the banks or diversify your bank accounts, have some other alternative assets like gold and silver, which is skyrocketing today because people may not be getting their money back after losing them to the regional banking failures that we're facing. But I'm going to get into today's video why the bigger banks are also facing the same problem that these regional banks are facing as well. Because make no mistake, everyone, the banks are in a full-on liquidity crisis, and we all knew the Federal Reserve was going to lift interest rates until something in the financial system breaks. Well, that has happened today, and it's broken something big. Now, the reason why we have to pay attention to this is because unlike Silvergate, Silicon Valley Bank is much bigger, with around $200 billion worth of assets and $175 billion worth of deposits. Many of those deposits are uninsured. So everyone, what happened with Silicon Valley Bank today? Why did it collapse? How did it collapse? And are the big major US banks facing the same issue? Well, let's not waste any time, everyone. Let's get straight into the news, the facts, and the data. So first things first, before FDIC announced the closure of Silicon Valley Bank, this was announced. Silicon Valley Bank fails to find buyer as running the bank outpaced sales process. So shares of SVB Financial tumbled 60% on Thursday after the bank announced a plan to raise more than $2 billion in capital. The stock then dropped another 60% in the pre-market Friday before being halted, and shares never reopened for trading. The bank sought a buyer after its capital raising attempts failed, sources told CNBC, but they failed to find a buyer. And look at this, everyone. So Silicon Valley Bank is shut down by regulators in the biggest banking failure since the global financial crisis. This is massive, everyone. This is big. We have just witnessed a Lehman moment today. But unfortunately, I think this could just be the first domino to fall, and this is going to be what ignites the fear, and we're going to see more and more bank runs happen this week. So the FDIC said in an announcement that insured deposits will have access to their funds no later than Monday morning. So according to a press release from regulators, the California Department of Financial Protection and Innovation closed SVB and named the FDIC as the receiver. And the FDIC in turn has created the Deposit Insurance National Bank of Santa Clara, which now holds the insured deposits from SVB. But I'll get into in a moment, a lot of these deposits weren't insured. And yes, while individuals may get $250,000 per deposits, there was a lot of businesses that had accounts here with much more money than $250,000, and they may be losing everything. As of the end of December, SVB had roughly $209 billion in total assets and $175 billion in total deposits. According to a press release, the FDIC said it was unclear what portion of these deposits were above the insurance limit. Well, we've got that confirmation. I'll get into a moment. The last US bank failure of this size was a Washington Mutual in 2008, which had $307 billion in assets. SVB was a major bank for venture-backed companies, which were already under pressure due to higher interest rates and a slowdown for initial public offerings that made it more difficult to raise additional cash. This is what I've been warning about, everyone. I've been saying as the Federal Reserve lifts interest rates, is going to make it much harder for these startups and these profitless tech companies to raise capital. We saw the party in 2020 and 2021. Everybody was just getting free money. All these companies, they didn't have to make profit. They just had to say they're going to change the world and they would have $1 billion valuation. Well, eventually reality has to hit, and we're starting to see a lot of the bad actors now be exposed. The closure of SVB would impact not only deposits, but also credit facilities and other forms of financing. The FDIC said loan customers of FDB should continue to make their payments as normal. That's right, even if you lose your deposits, keep paying those loans, everyone. Now, this is the juicy information which we need to get into. Will the big banks be facing similar fate? While many Wall Street analysts have argued that the struggle for SVB are unlikely to spread to the broader banking system, shares of other mid-sized and regional banks were also under pressure Friday. So we are going to see other banks come under pressure, everyone, as people lose faith in the regional banking sector, and we're going to see some more bank runs. Also, Treasury Secretary Janet Yellen said during testimony to the House Ways and Means Committee on Friday morning that she was monitoring very carefully developments at a few banks, and Yellen made her comments before the FDIC announcement. So that's right, everyone. She's just not monitoring this situation. She says a few banks. So How many is a few? We'd say at least 3, but maybe even more. So this tells me we're going to see more potential bank failures coming very, very soon. But what we need to know, why did this happen? And can this happen to the big four? Well, unlike many people that may just report to you what's happening, I'll tell you why it happened. So look at this, everyone. 300 billion reasons why SVB contagion is spreading to the broader banking system. So look at this. They were funded by 173 billion in deposits, which 151 billion are uninsured. So a lot of people aren't going to be getting their money. Has long-form view that the bank at the heart of the US startup industry, due to its singular focus on venture capital firms, in many ways it echoes the issues we saw at Silvergate, which banked crypto firms almost exclusively. But let's break it down in simple terms how this bank collapsed. So the bank had a lot of fixed rate and other exposures that were underwater, carrying an unrealized loss, and having concluded the rates will keep rising, the bank decided to restructure its assets and flip its portfolio from a fixed rate one where rate hikes cause even more potential capital losses to a short-term one where they lead to modest NIM gains. Of course, the transition ended up costing the bank billions. Now, this is something I was very, very worried about when I saw the banks reporting their earnings and how they hide a lot of losses. What a lot of these banks do with assets that have had big losses like bonds, they'll put it on another balance sheet called hold to maturity, and then it doesn't come up as a loss when they report their earnings. Now, normally this hasn't been a big issue for banks because we've been in an environment of low inflation or low CPI inflation, and also interest rates have just been going lower and lower. So they haven't had much losses from bonds. Bonds have been in a 40-year bull market. But now interest rates are going up, bonds are crashing, banks are facing huge losses. And for Silicon Valley Bank, these losses, these unrealized losses turn into real losses, and it was actually more than their book's value. So how exactly did SVB collapse? Well, first, raising rates of forward depositors, a completely risk-free way of parking your money at treasuries without taking on a company-specific deposit risk. So what we're seeing right now with the banks is a full-on liquidity crisis. What a lot of customers are doing, this is what I told you guys to do for the past 2 weeks, is they're not getting enough interest on their money at the banks, so they're taking their money out of the bank and they're putting into short-term treasuries where they're getting at 3-month treasury, 6-month treasury, they're getting a 5% risk-free yield if you held it to maturity. Now, it's okay if a few customers do this, but what happens if the majority of a bank customer starts withdrawing their money out of the bank and doing this? Well, the bank's going to go under. Second, rising rates force the bank to sweep ever bigger losses on its debt's assets under the rug. And yes, while the bank can hide behind the held at cost basis afforded by the held to maturity, the fact that the bank's HT hold to maturity book was of relatively moderate duration meant that even if it held to maturity, it would still suffer losses, which is why it proceeded with the previously discussed balance sheet restructuring. So again, first thing that caused the bank to go under was customers pulling deposits to put into short-term treasuries, and second, rising interest rates hurting the asset prices, these bond prices on their books, and they simply couldn't recover. So the SEC and the FDIC regulators require banks to disclose not only the value of the H hold to maturity assets, but also the fair value of said assets, with the fair value being, as the name implies, the value of the hold to maturity assets if they were to be sold today. The delta between the two is what is known as net unrealized loss, and is rapidly emerging as the most important indicator of bank health. Now, just look at this chart of SVB's unrealized losses, and then we're going to have a look at how this compares with the major US banks. So as we can see here with Silicon Valley Bank's own balance sheet, where it went from eventually no losses a year ago to the number climbed to 16 billion as of Q3. Now, this is a big problem because the bank's shareholder equity was only 15.8 billion. So these unrealized losses completely wiped out all its book value altogether. Now, okay, what you've been waiting for, well, how do the big four banks measure up? Well, look at this chart, everyone. This is absolutely terrifying. Here it lies. If it were only SIVB that had unrealized losses problem, then there would be no contagion and the rest of the banking sector would be safe and sound. Unfortunately, as explained, the reason why SIVB's hold to maturity book blew up is because of the surging rates, which is also why SIVB processed to liquidate its available for sale securities at 26 billion. And these are far less than the 91 billion in hold to maturity book, and it's also why every other bank is now suffering under the pressure of massive net unrealized losses. So we can see here Bank of America, JP Morgan, Citi, Wells Fargo, they're all sitting on massive losses. So how much totals? Well, 250 billion, and guess who's the worst? That's right, Bank of America. They have $110 billion in net unrealized losses. Now, these amounts may not sound like a lot, but when expressed in terms of book shareholder value for any given bank, they are staggering. Look at this chart, everyone. This shows the unrealized losses is when expressed as a function of total equity. Yes, SVIB is by far the worst with all of its book value wiped out by unrealized losses, but other banks are hardly doing much better. Bank of America unrealized losses, the market value cap between the hold to maturity book and fair value loss, represents 43% of its combined total equity, as State Street is 27%, Wells Fargo is 25%, and US Bancorp is 24%, and so on. So you can see here. So you can see at Bank of America, their net unrealized losses is 43% of its market cap. This is absolutely terrifying, everyone. Bank of America has nearly half of its market cap in unrealized losses. Can you see how this contagion effect is spreading to the broader financial system? And if the Federal Reserve doesn't do something very quick, the whole banking system could collapse. So the Federal Reserve is stuck in a very sticky situation now. Well, do they bail out the banks yet again and create surging inflation? Or do they let a few banks fail and rebuild from a more sustainable base, but we're going to have a full-on global depression? Now, do you remember the year 2019? What happened in the year 2019? That's right, that's when we had the repo market crisis, where the banks suffered huge liquidity issues and rates surged from 2% to 10% overnight, and the Federal Reserve had to come in there and bail out the repo market and not do QE and start pumping money in there again. So this is something I expect the Federal Reserve may do for these banks that are in stress. They may open another repo market facility, but again, more QE, the markets may speculate that the Federal Reserve is going to pivot and we're going to see inflation surge yet again. So there's really no way we can get out of this, without being scarred, everyone. Either we're going to pay the price for bailing out these banks, or we're all going to suffer from much higher and much longer inflation. And we did have a warning sign, and this is what I tried to warn you, everybody, and that is the yield curve. So look at this, everyone. The yield curve is now the most inverted it has ever been, down 1%. So that means the 2-year yield is yielding 1% more than a 10-year yield. And what a lot of banks do, they borrow on the short end and they lend on the long end. Also, something that hasn't happened before, M2 money supply is crashing. Normally, it's just only gone up and up and up. It's never had a year where it's gone down. But M2 money supply has gone from 21.7 trillion to 21.2 trillion. And if it keeps on falling again, we're going to have another massive liquidity crisis and financial crisis. So everyone, I don't think the worst is over. I think this just may be the beginning of this story of what is ultimately going to happen to the banking system. Will the Federal Reserve and the government come in there and bail out the banks yet again, sacrifice the taxpayer, use taxpayer money to bail out these big banks, sacrifice the middle class to just make these big banks even bigger? Or will they let them fail, teach these banks a lesson that you can't just speculate there, and when things go wrong, you get a bailout? Because what happens with us investors, if we make a bad investment or a small business owner makes us a bad business decision, we don't get bailed out. These big banks shouldn't get bailed out either. But unfortunately, I think the Federal Reserve may bail them out, and this means inflation is going to get much worse. So you may want to hold some gold and silver as a hedge against the inflation crisis that could be about to get much worse. But everyone, what do you think about this madness? Let me know down below. Now, for my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.